To see where everyone is calling in from. We got about 50 people who are with us so far, and the number is continuing to grow. So we're going to start in just a few minutes. All right, looks like we got Dean, a CFO from Toronto. We got Dan. Dan, nice to see you again. You are a regular attendee at these webinars. That's great to see you from South Carolina. Lisa Marie from Annapolis. Okay, we got a lot of people in finance and accounting here. Oh, John Hadley. Nice to see you here. We just connected a few days ago. And Rich, awesome. Well, a great list of people for a great topic here because this topic is extra special to me. It hits home given the fact that in just 4 days, I will be hitting a 7-year anniversary on my fractional CFO services firm, Mighty Digits. And when I started my firm 7 years ago, really the longest that I've ever done one thing in my entire career is crazy to think about. Right from the start, I was very fortunate to land a number of clients, and our growth was really incredible for a firm just starting out, primarily because of one thing. It wasn't financial operations. It wasn't bookkeeping. It wasn't tax work. All these things are valuable. But the number one thing was financial modeling, strategic insights. And in today's webinar, we have so many things that I haven't really heard people talk about before when it comes to strategic finance, given the fact that really the entire field is not really something that's taught in school. There's no FP&A major. The closest thing to that is maybe you're going to major in something related to finance, maybe even economics, maybe even like me, it's in accounting. And while you may start your career in the FP&A function, maybe more common if it's in a very large company, for small and medium-sized businesses, which is primarily what I work with and my favorite type of business to work with, it's pretty rare that right out of school you'll be able to break into an FP&A function because oftentimes there's only one or two people in that function and you already need the experience. So most likely someone is hired at the VP of finance level, which means in order to get this experience, in order to learn all of these things, you kind of have to do it on your own, whether it's self-taught, whether it's taking a course, whether it's doing some stuff on your own, working with AI, following newsletters. And because of that, it's not really such an easy field, but to me, it's one of the most valuable. And there are pretty strong barriers to entry. So anytime that we do a webinar talking about strategic finance, I have an extra special place in my heart because of the amount of value that really it added to my career. And I'm curious if anyone here can really relate to these questions, right? You're sitting in on a leadership meeting or a board meeting, and people are asking, hey, you're presenting this number over here, but that same number is presented differently over here. Why is that, right? Or maybe leadership or management, they're going to a folder where the financial model was supposed to be stored, and there are 6 different versions. And they're wondering which version is the live version and which version are we comparing against? And do we have a potential access issue because this person edited something on Monday and that person then edited something on Tuesday? And it really all ties to how strong of a function that you have. How strong is your financial model? Not only in terms of the outputs, in terms of the beautiful dashboards, with anyone here who's been following my content knows I'm a sucker for a beautiful dashboard. But before you can design that beautiful dashboard, you need to ensure that the data that you're showing is correct. Because if the data is not correct, as we'll soon see in today's session, well, nothing else really matters. And all it takes is one mistake in your financial model for someone else to point out to destroy the entire credibility. It's the equivalent of looking at a balance sheet and noticing that assets don't equal liabilities plus owner's equity. But can you really trust anything else that's shown there if that information doesn't tie? But as we'll soon see, a balance sheet tying is really just one area of a financial model where the accuracy needs to be on point. And I'm excited to cover all of that in today's session. So, in terms of what exactly we're going to be covering, well, it doesn't matter whether you are working at that early stage startup, like we were speaking about, where the bar is extremely high right out of the gate because there's no tolerance for training someone, for getting them up to speed, and 8 other people who can do something in a large 1,000-person plus organization. As a company is growing, the needs are constantly shifting. We're in the early stages. Maybe you're just handling the financial reporting. Maybe you're just managing a small segment of the accounting operations, like accounts payable or accounts receivable, or maybe even payroll. But as the company grows and matures, so too the demands of the company grows and matures as well. Now, you no longer need to just keep up to pace with what's happening in the company. You need to be able to constantly look at what is going to happen, whether it's a long range budget for the next few years, a shorter range budget for just the next year, or maybe even an immediate future of just the next few weeks. And as we'll soon see, creating the financial model is really just the first step. That's not even 50% of the way there. I would honestly say that's only 10% of things. That remaining 90% involves every single month, ideally even sooner than that, checking the assumptions, rolling forward the model, understanding how close you were to what you thought was going to happen and what actually took place. And all these things we're going to be talking about in today's session. And I'm excited because we have an amazing company who has sponsored today's webinar, who's going to be participating in this, ApprovalMax, which we'll share a little bit more about in a second. But we're going to be going over a number of different areas on a financial model. We're going to be talking about what makes a strong foundation in a financial model. Where as long as you have that foundation, like a really strong tree with deep, deep roots in the ground, even during the most scary tornado, can still withstand the pressure and stay erected. We'll talk about how to build that foundation. Then we'll talk about all the other areas once you have a three-statement model in place that are important to nail. So we'll talk about revenue forecasting. We'll talk about P&L forecasting. We'll talk about headcount forecasting. And finally, the trickiest part that can be solved with the right framework, balance sheet forecasting. And then in part two, we're going to be hearing from today's sponsor, our sponsor who helps keeps all of our webinars entirely free for you guys, ApprovalMax. We'll be going over what exactly happens then after the model is generated and what exactly you can do in order to make sure that all the information that you're presenting in that model, that you're analyzing each and every single month, continues to be refined and is as accurate as possible. Now, I imagine most of you have already been part of a number of my webinars. I noticed a lot of familiar faces in the chat. It is so great to see all of you again, and really kudos to you. I wish that I was familiar with webinars like these earlier in my career, because it would have taken me so much less time to grow and add the skill set that I've grown to through starting my own firm and everything else if I was aware of webinars like these. So a huge kudos to all of you for once again on a Thursday afternoon making that investment in your career and yourself, showing up today. For those of you who aren't familiar with me, aside from starting my firm about 7 years ago, it was about 4 years ago that I started posting content in order initially to just drive more awareness to our fractional CFO firm. What I never expected would be what we have here today with this Your CFO Guy brand and this studio and hosting webinars like these each and every single week. It has been an incredible journey getting the opportunity to not only share my experiences and my learnings with each and every single one of you, but even more valuable has been hearing from each of you, me, myself now learning so many different things about finance and accounting, because the truth is our field is an incredibly versatile field. There's so many different areas of finance and accounting. There's so many different specialties, and there's a never-ending list of things that you could actually learn. Now, aside from that, I've also been fortunate to create my own Excel add-in, which has helped me reshape the way that I think about financial models, as it's a financial modeling tool. And with me over here becoming a Microsoft MVP, I don't know if you can see my trophy right then and there, it's given me a much deeper appreciation for Excel, which to me is the #1 tool for finance and accounting professionals, especially when it comes to financial models. Because with a proper Excel file, people understand the structure. They understand how they can quickly manipulate things. They can see the actual formulas. It's no black box. It creates that very easy to understand transparency that you need in a financial model, especially when you're working with a team. But it's not just me on today's session. It's my pleasure to introduce Rafaella from the ApprovalMax team, our financial controller, who's going to be participating in today's webinar. Rafaella, would you like to share a little bit about yourself before we begin?
Sure. Hi, everyone. It's great to be here today. I'm the corporate financial controller at ApprovalMax, and we are a UK-based SaaS business operating globally. Essentially, we focus on helping companies streamline and strengthen their accounts payable and financial approval processes as you scale. So our platform integrates with Xero, QuickBooks Online, NetSuite, and I'm really looking forward to today's conversation because I'm in the finance team myself. So this topic really resonates with me too.
Me too, Rafaella. I do see someone say that I can't hear, not sure if this is a setting issue. I imagine everyone can hear me. So, Abdulaziz, it may be something on your end, but if anyone else have issues, then you could let me know. Thanks for confirming that, Javier. All right, well, let's jump into the meat and potatoes of what we're going to be covering today, because I want people to walk out here with a new philosophy of what a proper financial model actually looks like. It's a financial model where everything ties together. Now, if you're not familiar with what tying together means in finance and accounting, we're going to go deep in this because this is probably the most important area for ensuring accuracy in your financial model. We're going to be talking about what you can do so that when someone receives that financial model, because you, I promise, will not be the only one analyzing this financial model. An investor, especially at a fast growing early stage startup, is going to want to review all of your assumptions, especially if they're about to invest a significant amount of cash into the business. So, we're going to go over how to make sure that those investors can ideally not only break the financial model, but ideally they take a look and say, who is this person that put this together? I want to speak with him and her because I'm genuinely impressed. And yes, I've had that happen multiple times in my career. And these investors will not only add credibility by helping you raise additional capital, these are amazing people who can be in your actual network throughout your entire career. Whether you're a fractional CFO and are relying on partnerships with investors, or whether you're a VP of finance and you want to keep a really strong network, the tools that we will teach will help build that credibility that can last with you for your entire career. And we'll go over the process for how exactly financial models can be refreshed with new information. Because, like we spoke about, when you create that financial model, maybe you're 10% of the way there. That remaining 90% comes from refining and constantly refreshing that information, comparing against your variances. Now, if you do have any questions, I do encourage you to put all of that into the Q&A section, because the Q&A section is where, at the end of today's session, we'll be able to go over each and every single one of the questions. We have a decent amount of time, so I am confident we'll be able to get there. And before we really just dive into everything, I want to remind everyone about what exactly we're facing now with this unique time that we're in. It's wild. For those of you who are millennials, just like myself, we grew up experiencing the explosion of the internet. Now, I was maybe only 10 years old or so when the dot-com bubble burst and everything, but I do remember those days of dial-up and someone not being able to use my phone while I was on the internet and America Online and that you've got mail, right? Everything changed with the internet. People who used to do the budgets by just writing that in by hand and mailing that over to a client or something, well, now you have this incredibly new disruptive technology. And the same thing really is happening with AI. And people, including myself, they're overwhelmed, right? Because every single day you see another post on social media that AI can now do this thing, an entire industry just got erased in 1 second. And all these big companies are doing these layoffs, and it's all because of AI. The times indeed are changing. What was not possible just a short period ago now is becoming possible, and that is quickly shifting. But my philosophy is that that makes the understanding, the foundation of everything that you're doing that much more important. For anyone who's familiar with software engineering, you know that now you can ship things so much more quickly. But the bar, the amount of effort for QA, for quality assurance, for making sure that the data is accurate is now 10 times higher. Because AIs, they hallucinate. They do things without the full context. And it's your job to be able to validate if the information is correct or not. And you have to know what correct even looks like before you could do that. So the shift that I really want everyone to think about is, with the right frameworks in place, it doesn't take a lot of effort and complexity to build the right financial model. You really just need to ensure that you have a certain amount of structures in place in order to make it easy not only to create that model, but also refresh that model. And while accuracy is primarily what we're going to be talking about today, there's also efficiency in what you're doing. You don't want to set something up, making sure that it's accurate, but it took you 4 hours to do. So now every single month, you have another 4 hours that you need to repeat. So we're going to be going over ways in which you can take your information and we can, in an efficient way, continue to manage that on an ongoing basis. So let's get started with first the layers that tie into all of this. And this is what we're going to be speaking about. We're going to be starting with this first layer, right? We're going to go deep on what a strong foundation in a financial reporting system looks like. Now, when I say financial reporting system, yes, that is another word for a financial model. But remember, a financial model, it's really like a control panel for the entire company's finances. It helps you understand where the company has been, where the company is going, what are the inputs and levers that can be tweaked in order to get there, and whether these assumptions are rock solid or completely pulled out of thin air and need to be adjusted. After we go over that foundation, we'll talk about probably the most important area for a business: sales, revenue. In fact, most models that I see at the very early stage, they're really just a revenue build. All it is showing to investors, maybe at the seed level, this is how we plan on penetrating the market. This is how we plan on generating sales, finding that product market fit. And while that's valuable, as you get to stage 2, the truth is it's still not the full picture. Because just like a doctor takes a look at lab results to understand the health of its patient, so too in finance and accounting, we take a look at financial statements in order to understand the health of a company. And the next stage, especially for those companies on the cash basis, is going to be your profit and loss, where the biggest area of the profit and loss is going to be your headcount, making sure that that expense is dialed in and correct. And we'll go over a few important considerations that you need to bear in mind with the profit and loss. But majority of companies, especially as they mature, are on the accrual basis, which means what they show on their profit and loss does not equate to their cash flows. And that balance sheet, which shows the position of their company, well, that is the bridge between what is happening from a profitability perspective and how that translates into a cash flows perspective. Now, we're also going to be sharing a template at the very end of this session where I could show you how this actually looks all in practice. And you're all going to get a free copy for showing up today. For those of you who have already been to a bunch of these webinars, you already probably have your version of it, and it'll be a good refresher. So let's now dive in to that foundation. Creating a 3-statement model. Now, again, I want to just be specific here. When I say 3-statement model, I'm a huge fan of the idea that models should include all 3 statements. But that really has to do with how big the actual company is. Generally, when a company grows past, let's say, 400 to 500 staff members, they're no longer an SMB, most likely. And they may not have a 3-statement model. Instead, they may have a dedicated treasury function. But for all those companies who are SMBs, a 3-statement model is key. And just understanding the logic of a 3-statement model will add tremendous value to your career. In fact, I have to be honest, of all the things that I learned in my career, creating a 3-statement model probably has added the most amount of value. And the concept is not really so complex if you understand how financial statements work and how they are connected. So we already know the profit and loss tells you about the profitability of your business. The balance sheet tells you about the position. And the statement of cash flows tells you where exactly your cash is moving. What most people don't realize is that the balance sheet really contains the most amount of information. The reason for that is that your net income from your profit and loss flows through into your retained earnings. So if you just follow this little dotted marker over here, your retained earnings balance, which may be split through another net income line item on your balance sheet each and every single month, is really just an accumulation of your profits or losses each and every single month or each and every single year. Your profit and loss is really just showing the details of that through your income accounts, your revenue and other income, and your expense accounts, COGS, OPEX, and other expense. But even more so, the statement of cash flows, what most people don't realize, especially under the indirect method, which is the most common with financial modeling, the statement of cash flows doesn't really generate or show you any new information. The statement of cash flows is really just taking the difference of every balance sheet account except for cash. Because the accounting equation states that your assets must equal your liabilities and owner's equity, as long as you take the net difference of every account except for cash, your cash now becomes your plug. Now, I'm not going to go into crazy detail on this. I have a YouTube video. I'll share my channel at the end that really breaks this down. I have a full comprehensive course that then goes into the details of all this. But here's the idea. I'm going to just repeat this one more time because when I really understood it this way, I just saw financial statements from a whole different mechanism. Once again, if you know that assets equal liabilities plus owner's equity, you know in addition to that, that the net change from one period to the next in your assets must equal the net change from one period to the next in your liabilities and owner's equity. So the idea with the statement of cash flows is that by taking the net difference of every account, except for your cash, you're going to have a plug where the information no longer ties. Now, you also need to apply a -1 to your assets because if your assets grew from one period to the next, that means that it was bad for cash flows, whereas liabilities and owner's equity, as they grow, it is good for cash flows. A little bit counterintuitive, but by doing that, that gets you your statement of cash flows. And yes, there are some more nuances. Technically, you pull net income from the income statement, which again is an accumulation of your retained earnings. You add back your depreciation from the income statement, which is really just the net difference in your accumulated depreciation, assuming no adjustments. But just by understanding this part over here, you should be able to take any set of financial statements directly from your accounting software, an income statement, and a balance sheet, and automatically create a three-statement model. So once again, I'm going to share that video to on my YouTube channel later on, and you should be able to see that in more depth. But by understanding this unique way, which I haven't really heard people talk about, you already now have a foundation for creating your financial model. That first part, that three-statement model where any changes to your income statement and your balance sheet flow through across all three of your financial statements. And it's not enough to just have that three-statement model. It's important to be able to have the right structure in your financial model. Now, I remember my FP&A manager that early in my career I was working with, she told me that her boss, once upon a time, explained this concept, the importance of having a driver's tab, where as many inputs as possible are consolidated on that driver's tab. And again, this goes back to the idea that you're not going to be the only one in the financial model. There are most likely other people in the FP&A function. Management and leadership is going to be having a look. Maybe department heads are going to be looking at different areas. Maybe the board of directors, maybe investors. Each of these people are going to be working with your financial model. And you don't want to have a 1-hour call with each of them just showing how to work with things. So the right structure, ideally via a consolidated driver's tab, where as many inputs as possible are set up, is ideal. So as people make those tweaks, the entire model then updates. And that's exactly how we have this with our financial modeling tool, ModelWiz. We have this one driver's tab, and every assumption is tied directly to that tab, and it sprouts out to all the dashboards, all the different inputs that you need directly from that one tab. So when you have now the idea of a three-statement model, a consolidated driver's tab that has the historicals and the projections in place, let's now talk about the structure of your file for how to even import and tie that all together. And that's something via a term that I coined called the Excel SIP framework. And it stands for sources, inputs, and presentations. Now, when we go over in Excel later, if there's enough time, I could walk you through and show you how I have this set up. But the idea is you want to keep these three different sources. You want to keep them separate from one another. You want to have your source data, which comes from your accounting software, maybe your CRM, maybe your headcount information. You want it in its raw native format. because every change that you make to that format will then need to be repeated each and every single month, unless, of course, you use a tool like Power Query. But either way, the starting point needs to be the way the data comes from whatever database or software you're using, which you don't have control over. When you have that source information in place, so in this case, it's going to be your historical profit and loss and balance sheet, right? We're trying to create that three-statement model. When you have that profit and loss and balance sheet in a separate place, you're able to copy and paste that information each and every single month to have your entire model update. The idea is to then, via that drivers tab, you attach the information to those source tabs so that you could then layer on all your projections and all of your assumptions tied to that historical data. So if you're taking a 6-month average, well, you're bringing that data in from your source tabs and you're layering in a 6-month average as a formula with maybe some sort of a buffer. When you have these two pieces tied together, the third part of the Excel SIP framework comes down to then presenting that data. Because the data may be the most valuable information with the most accurate projections in place, but if you don't have a way to communicate that, it'll be entirely futile. And these dashboards, these presentations, they shouldn't be a mixture of inputs and source information. They should really be read-only data that ties into your sources and your inputs. Maybe you have a toggle or something like that, but all the information ties in so people can now consume the data in one place. They can edit the data in another place, and each month they can refresh that source data with just a simple export, just a simple copy and paste. Now, it could get a little bit trickier if you have new accounts and everything. That's the whole reason we created our software. But the idea is still simple. And that's still the idea of how we even designed our software. The source information is all that's updating while the inputs stay attached to it. Now, when you have all three of these in place, you may have a serious vulnerability that you don't realize. And this is actually something that happened to me. One of my best clients, the longest standing clients, who's been with me almost since day one, they raised an $18 million round of funding. And with that round of funding came new investors. And their investors said, hey, I'm noticing you don't really have anyone on your finance and accounting team. You just use this company called Mighty Digits, who we've never heard of. That makes us really nervous. And the CEO said, I promise you, this company is doing a great job. They got everything down pat. Don't worry about it. He fought to keep me on the company instead of replace me with a full-time hire, which I would understand if he did. But what I didn't expect was that when we presented at that very first board meeting, I had a glaring mistake in my financial model. A mistake that caused me to overstate our cash balance by the end of the year by $3 million. Probably the worst mistake that you could possibly make. And it was all because I didn't have proper error checks in place. So I'm going to talk a little bit about error checks. But first, let's do a really quick poll. How many of you have error checks in your spreadsheet? And it's not just an error check in a financial model. It's really any spreadsheet that you use. How many of you have a system for automatically flagging and identifying, hey, there's an issue with this data. It is not entirely accurate. I'm going to take a look at the information as we fill that all in. And before we talk about error checks, a very underrated area of a financial model, which can do wonders for the accuracy of everything that you're presenting. We'll give a few more seconds for you guys to put in your answer and vote on that poll, and then we'll see how everyone did. All right. And the results are in. So the majority of us, almost half, say some checks, but nothing really systematic. 23% of us do have them built in from the start, so that's great. I hope that maybe I inspire you with some of the things that I show you and still teach you a trick or two. 15% of us, not really. They don't really have anything at all. And then 14% of us, well, they're going to be adding it to the to-do list. Well, I'm going to show you just how simple the concept is. And I'm going to explain this in a way where no one really explained it to me. Because when I first understood the idea, you need to have an error check, pretty much a system where your model will say, hold on, stop what you're doing. There's an error here. Don't trust these numbers because something got misaligned. I understood the simplest use case of an error check, and that is Do assets tie to liabilities and owner's equity, right? If I have a formula that calculates assets minus liabilities and owner's equity, if that formula returns anything other than zero for any period in my financial model, I want to be alerted. That's a very simple error check, right? Everyone understands the accounting equation needs to tie. What I didn't understand was how do you really apply error checks everywhere else? Well, I came up with this analogy. Let's say you're going on a field trip with a bunch of children. All the children are getting on the bus. When the children get on the bus, you have your notepad and you're checking off each and every single person, and that child is there. You get on the bus, you then drive to that field trip. When you then get off the bus, you want to do another roll call. You're going to want to make sure that all the children who were there at the beginning are there coming off. You want to make sure that, God forbid, none of the children jumped out the window or anything like that. Well, it's the same thing with your data. When we spoke earlier about this concept of your data tying, another word that us finance and accounting professionals oftentimes use is your data footing. The idea is when you bring data from one location in a spreadsheet to another location in a spreadsheet, you need to make sure that the subtotals and the totals match to one another. So a concept can be, we spoke about the SIP framework. You bring in your profit and loss, you're bringing in the values for each and every single account. Well, your total revenue, your total COGS, your gross profit, those are going to be recalculated. So now you have calculations from your initial export for revenue, COGS, and gross profit. And now you have calculations from your new drivers tab recalculating those same values. If there's a difference between both of those places, well, that should scream at you, hey, you didn't bring all the information in correctly. Hey, all the kids who went onto the bus are not equal to the amount of kids who came off the bus. Maybe one of those kids are hiding underneath the seat. And it's up to you to fix that. That's the beauty of an error check. And the idea is that you can never have too many error checks. Each of these error checks come in and should be set as a flag on every tab saying either your model is functioning properly or there is an error. Once you build in that error check, the next step is to help you create a model that is entirely dynamic. That involves formulas that allows you to get the dynamic tab name. That allows you to create dates that easily scale from one period to another. And one of my favorite tricks, creating named ranges that can be reused and instantly sliced and diced to get your information. So it looks like we're at 12:33. We have a few more areas to now cover before we get into part two. And the mechanism in which we're going to be going over that information ties into, once we have our actuals, how to then get all those projections. And like we spoke about, those projections primarily start with your revenue forecast. That revenue forecast, what most people don't realize, comes from three separate locations. Revenue from your existing customers, customers who are already doing business, who have renewals, maybe even upsells. Then you have customers who are warm in your pipeline. You've already been in touch with, they haven't closed yet, but you have a weighted average or projecting them to close at a certain period for a certain value. And then finally, your new customers. And with your new customers, even though no two businesses are alike, with the right framework, you could forecast any business model. That business model allows you to understand how you acquire those users, how long those users stay with you, how much they pay for which product, and finally, all the other areas of your financial model that are going to be affected, whether that's your receivables, whether that's your COGS, whether that's your inventory, all of that tied to your revenue build. And once you have that revenue build in place, like we spoke about, while that is the second layer, we now have layers 3 and 4. For the next layer over here, forecasting out your profit and loss, one of the most important aspects of that is going to be your headcount. Now, I'm actually working on a new YouTube video that should be going live shortly where I break down how exactly to forecast headcount and how to think about it. But the idea here is, again, your headcount is most likely not only the largest expense in your business, but also the most difficult to contain, to control. If you want to turn off a piece of software, you most likely can just hit end subscription. If you want to get rid of someone in your company, well, most likely you need to put them on a performance improvement plan. You need to give them notice. You need to apply severance. You don't want to risk a legal battle. So with your headcount forecast in place, it's important to get laser focused on the details. If someone starts in the middle of the month, you need a print rate. If someone is terminated mid-month, same deal. And for full-time employees, what else do they get besides for salary? Well, they get payroll taxes, they get health benefits, they get payroll admin fees. So now you need to layer on most likely a 20% buffer for all of your full-time employees. And what I like to do is with that drivers tab you saw earlier, for all of my P&L line items, except for revenue and except for headcount, I just have a drop down, 3-month average, 6-month average, prior year balance, prior month balance. When it comes to headcount, that's when I attach a whole separate tab utilizing this function over here with the let function. And with your headcount and your P&L out of the way, you now have a 3-statement model. You have the proper structure with the drivers tab. You have proper error checks in place. Your file is set up with the Excel SIP framework so you can refresh it. You forecasted out your revenue. You forecasted out your headcount. There's one last step in place. This to me is stage 4 financial modeling, and that is your balance sheet. And while it's tricky to forecast the balance sheet, it all really comes down to this framework, the base framework. Every balance sheet account, it differs from the P&L because it shows our balances on a cumulative basis. That cumulative basis means you take your beginning balance, which will be your ending balance for your latest month of actuals. Whatever the amounts go up, you add. Whatever causes the account to go down, you subtract, and that gets you to your ending balance. So I want to just do a really quick game over here in the webinar chat. Let's talk about an example for accounts receivable. Who can tell me what makes accounts receivables go up? What event in a company triggers an accounts receivable going up? And what event triggers your accounts receivable balance going down? Because if you understand facts for each balance sheet account, it becomes really simple to forecast out the balance sheet. So just let us know in the chat, what makes accounts receivable go up? And what events make your accounts receivable go down? So Anna says, sales make your accounts receivable go up, and that is technically sales on credit. And payments or collections is what makes your accounts receivables go down. Deferred revenue, invoices make it go up, revenue makes it go down. Inventory, purchases make it go up, cost of goods sold makes it go down, and on and on. When you understand that pattern, it becomes really easy to then forecast out the entire financial model around specifically the balance sheet. Now, with everything in place, remember, there's still so much when it comes to data accuracy, especially when we're talking about SMBs versus enterprises. And that's why I'm really excited to invite back Rafaella, who has this experience working hand in hand with SMBs, to chime in here. And Rafaella, the first question that I have for you that I'd love to understand is, why exactly are SMBs more vulnerable than enterprises when it comes to data accuracy?
That's a great question. And well, enterprises have layers built in, and this can include segregation of duties, it can include internal audits, ERP controls by default. And what we see is that as SMBs grow faster than their processes do, things start to crack. And because normally the finance team, there's often 1 or 2 people, the controls were designed for a smaller, simpler business where actually now they're growing. And so what worked for 20 invoices all of a sudden starts to crack when they get to 200 invoices. And that's when really we start asking the questions, have we set ourselves up to scale? This is a common concern and error in startups today.
Well said. And where exactly do those errors come up?
I would have to say definitely the AP and the payment workflows. And this is just because invoices can be approved by the wrong person, or there's no real process at all. Sometimes there's not even a budget in place. So I've worked in finance departments for over 15 years now. And often what I see are payments going through on a verbal okay. There might be an untraceable email chain. When we get to the end, we're trying to find who approved this, who did you speak to? And so there's also manual journals that sometimes are posted without a second pair of eyes. And then when we get to vendor master data, that's when we really start having issues because we see duplicates, we might see outdated bank details. The record shows nobody is really reviewing this for maybe 6 months, a year. If you ask yourself, when was the last time you reviewed your vendor data, management? Normally it's every semester or annually, rarely quarterly or monthly. So this is definitely a concern. the pattern is normally that the model is sound, but the process around it isn't. And that's what we really have to focus on, is that foundation you were talking about from the start. Newer people, I believe that SMBs just needs your chance to catch it as well. So there's not really a big process in place set up to be able to, mitigate these risks.
And it's like what we were saying before, right? What got you here is not going to be what gets you there. When you're a small company of less than 5 people, you have a handful of vendors, there isn't really so much of a concern of doing an audit like this. But when the company grows to 20 people, 80 people, 200 people, each stage requires a whole different blueprint. And again, most of this is not really taught in school, and there's very little tolerance or patience for go ahead and figure it out, right? Companies are expected to have the staff that know how to adapt as the company actually grows and matures. So from your perspective, Rafaella, I'm curious, what exactly are the gaps that you see most often when it comes to vulnerabilities?
Definitely. I feel definitely the biggest one, I think there are three main gaps actually. So we have approvals without any accountability. That's a really big one. We have finance scaling faster than the processes. This is a big one across the board. But then there's no real clear ownership of the control environment. So who handles it? Is it finance? Is it ops? Who takes this under their belt? So with approvals without accountability, we can just say things like approvals over email, or Slack or verbally. There's an agreement in place, but really there's no audit trail. And that's when things start to get impacted. Also, when something goes wrong, you can't just reconstruct who approved what and when. So it's hard to have these audit trails. So even sense checking, could you show your AP approval process to an auditor tomorrow if you needed to? That's really difficult. And this is something that finance departments struggle with when it comes down to audit season. On the finance scaling faster than processes, this is a big one too, because the business usually doubles in the size, the transaction volume triples, but the process stays the same. So how are we tackling that? And so the risk at this stage is usually errors. It's fraud sometimes, but not necessarily. Normally it's just human error. It's duplicate payments. It's invoices approved without the context. It's invisible spend at month end, or maybe annual POs or committed costs you didn't anticipate. So definitely something to be looking at. And in terms of the clear ownership of this control environment, the most common one that we see is who controls it. Oh, everyone does. There's a big workflow. Everybody's looking, everybody's approving. I'm sure the person before me that approved is checking, or the person next to me will check for sure. But no one's actually looking into it. So the CFO assumes that maybe the controller is checking, the controller assumes that maybe the AP team is flagging it. And as a result, the control environment just looks complete on paper, but then it actually has real gaps in practice. And that's what we want to turn away from.
One of my favorite sayings, the fastest way to starve a horse is assign 2 people to feed it. I think that ties into what you were talking about with the accountability.
Yeah, for sure. And I think that's really what we need to look at. We're talking so much here. Today we have CFOs, we have FP&A people on this call, and you're only as good as your numbers. And the model is rarely where the numbers go wrong. You can do the gray area checks we talked about just now, but then you have to look at the foundation. The risk really kicks in when the figures become real transactions. So do we have the POs? Are the payment runs correct? Are the journal entries correct? At what point are you no longer in a controlled spreadsheet environment? And then all of a sudden, you're in the process field where it's a world of human handoffs and email approvals and manual steps. And bear in mind, this is also an operational environment. So most SMBs, they haven't really put together a formal control around this. And so as you build rigorous models, you have to be looking at the starting points. You got to get the foundation right to build off of that. And so with ApprovalMax in particular, this is what you get, right? And to be fair, these are 3 questions that you should ask any finance workflow, not just, if you're thinking about ApprovalMax, but these are some of the questions. If this went wrong, how quickly would we know? Could we reconstruct exactly what happened and who was responsible? And this is not to point fingers, but rather to find out what went wrong. How do we mitigate the risk? How do we, fix root cause? And is this still designed for the business we are today? And is it going to be the same one we're going to use going forward? Like you said, it's not how we got here that we're going to get there. So we need to think of these steps when we are organizing these workflows.
And for a company that's wondering how exactly do they get started with plugging these gaps, what would you say to them?
Well, I think, to be honest, if you're starting from scratch, then start from here. Map your current AP process, workflow end to end. Think about what makes sense to you and to your business. What are the tracking categories you have available? What are the budget owners? From the invoice to when it's paid out, write it down, map it. Most teams find the gaps just by doing this exercise. The step two would probably be who approves what? Is this documented anywhere? So that's really important as well, is we kind of all know that HR kind of goes to this person, but should it really? Is this the budget owner? Is this the person who put the budget in place? And so we have to make sure we have these people jotted down and understanding what their level of cover is and responsibility and accountability over these approvers. Check your vendor master. That's always really big. When did you last review it? Are there any duplicates? Are the bank details verified? Is this the quickest win that we've overlooked potentially? And what I'd say is pick one workflow to tighten first. Sometimes we don't phase out these big projects and we're trying to go crazy and get everything right. Whereas maybe the goal should just be to start off at one point, make sure that looks right, and then kind of piggyback and then go off from that, And so it's not going to be something that's done in minutes or in weeks. It might require more time. It's going to be, hit and miss. And as you find these, guidelines and, guardrails, then you'll be able to set it up properly.
So what exactly then does it look like once you have it in place?
That's something everybody asks, normally controllers. And so for me, I think the principle is the control should be built into the workflow. It shouldn't be bolted on after. So normally what we see is when we get to the FP&A section, the FP&A coming back and saying, why are you guys allocating this cost to the HR department? Actually, it belongs to the finance department. And so it shouldn't be that way. We should be doing it from the start correctly and mapping these approval flows correctly from the start. So define the approval flow chains definitely is the best way. Who approves what, up to what value? What happens if they're unavailable? Write it down. Don't just assume it. Write these processes down. Check for segregation of duties as well. The person raising the PO shouldn't be the person who's approving it. Even if it's a small team, try to find workarounds so that you can have more people involved, especially for error, but fraud as well, right? We have to be looking at that, unfortunately. Audit trails by default, every approval, change, exceptions, it leaves a record. That's really important because it's really hard. It's really easy to edit on some of these ERP systems, and you just have to make sure that you have an audit trail for any changes. And visibility before month end. I think that's a really big one. So the controls that only surface when you get to the FP&A, when you're doing a budget versus actual, when you start seeing actually this was mapped completely wrong, or this has been mapped wrong since January, and then you're doing year-to-date adjustments on your numbers, which also can mess up your figures, right? It can mess up your numbers and your model.
I believe you guys help with a lot of that. Do you want to share how that works?
Yeah, sure. So here's what you would get with ApprovalMax effectively. So we do automated approval workflows, and this is for bills, for purchase orders, for expenses. And we have a multi-step role-based approvals as well. So the right people sign off every time. So there's consistency in that regard. It's a seamless integration, whether you're using Xero, whether you're using NetSuite, QuickBooks. It's an online integration. It's very straightforward. And you get the complete audit trail for every decision. So there's no chasing emails. And I think I've said this to you offline, Josh, but because I've worked so many years in the finance department, and now I work at ApprovalMax, it's so nice to come into an AP department that works and that is a little bit more seamless than maybe the other effort that I had to put in the past, with the AP departments. It really does work. And I'd invite all of you, if you're considering something or just want to check how you're doing things and maybe compare it to something else, then sign up for a free trial. That's always available as well for everyone.
Well, thank you for sharing that, Rafaella. We're going to do a really quick poll. I'd love to hear if anyone is interested in learning more information about ApprovalMax. Once again, a huge thank you to ApprovalMax for sponsoring today's webinar, for bringing us all together, and for keeping these thought leadership sessions entirely for free. So definitely go ahead and check out ApprovalMax. In just a second, we are going to go to Q&A. and we'll answer all of your questions. But I first want to just do a recap of what exactly we covered today. And then I'll also share the link to that financial model where you can see everything that we spoke about in place. So first and foremost, right, the best financial models start with a really strong foundation. That foundation includes a 3-statement model for an early stage SMB, the proper structure following the Excel SIP framework where your sources are separated from your inputs and then your presentations, a drivers tab where the majority of your inputs are consolidated, and of course, most importantly, the topic of today, data accuracy, error checks, scouring every area of your financial model to make sure that there are no errors in place. When you get that information, the foundation in place, then you can move on to the revenue forecasting, the P&L and headcount forecasting, the balance sheet forecasting, all covering the frameworks that we spoke about. But in addition to that, right, your job is not done once you create a financial model. It comes down to then analyzing the information, rolling forward. How I detected that scary error that I had in that financial model was because the next month I rolled forward the information. I detected a huge variance. But errors, accuracy issues, those aren't just for your financial model. That really applies to the control of your entire finance function, which was great to learn from ApprovalMax, all the different suggestions for how you could actually plug those gaps. So we have over here a bunch of links that we just shared directly in the chat. You can learn more about ApprovalMax. You can get the full financial model by just clicking the download a copy button from the link over there. And then you can check out my YouTube channel where I mentioned that I have a lot of the content in more depth that we spoke about today. And if you'd like to connect on LinkedIn, just in the connection request, say that you were at today's webinar so that I know to expedite the review and approval of the connection request. So at this point, we're now going to get into the questions. I'm going to invite Andrew from ApprovalMax's team to help confirm and moderate the questions that we can go over for the next 8 or so minutes. Whenever you're ready, Andrew, you can come off mute and share with us the questions.
Thank you so much. And thank you all for your questions. Please feel free to put any in the Q&A, and we will try to read them as much as we can before the end of the webinar. Our first one is from Anuj. He says, my financial model is very detailed and has lots of checkpoints and sensitivity tables, and that is causing the Excel file to be very large, but that makes it difficult to share. However, if he translates it to a Google Sheets with lots of tables and a lot of the tables and formulas don't work. Is this something that it can be solved somehow?
Great question, Anuj, and thank you for sharing that. I have found that while Google Sheets is great for collaboration, it oftentimes is a lot less powerful than an Excel file. So if you're having issues with an Excel file, it's very rare that you'll be able to replicate the information from your Excel file into Google Sheets at faster performance. And like you mentioned, a lot of things also have cross-compatibility issues. That's one of the reasons why I use Microsoft SharePoint. It's the Google Sheets version where you can use it both online and you can also collaborate with people natively in Excel. So that's just a note on the Google Sheets part. In terms of the error checks causing issues, I would have to learn a little bit more about how your model is structured. I did hear you say something about sensitivity tables. And when you say sensitivity tables, that may be Excel's data tables feature, which is easily the most resource-intensive feature that Excel has to offer. Now, you can change the formula to say, instead of automatically calculating information, you can change it to only calculate, but not data tables. That may actually help. Again, that's assuming your sensitivity tables are utilizing these data tables, which are very resource intensive. Other things that can cause that is if you have a lot of data points. So for example, when we work with companies that have classes, right? Now you have a general ledger, not only by account, but also by class, and you could have thousands and thousands of rows. That could also really cause your file to blow up. Similarly, with referencing an entire large range could also cause it to blow up. So the error checks themselves should be very lightweight. I don't think that's really your issue. Most likely it's another underlying issue of how you have the information tied in. If you want to maybe post another question, sharing some more details, and we'll come back to that after some other questions, I'd be happy to get into that.
We do have another question from an anonymous asker. They asked, all of these financial models that I have been making with checkpoints, analysis, observations, etc., in days can now be done by AI in just minutes and with almost 100% accuracy. How do you think that we can do more to make ourselves relevant in the eyes of our CFOs?
It's a great question, a very relevant question in today's day and age. I think to me, Claude is the one that's leading everything. And I would probably push back to say, when you mentioned it's just as good as I would have done with close to 100% accuracy, the accuracy has certainly improved and it's amazing what it can actually do. I haven't found it to be as comprehensive of what a true world-class financial model with the right inputs and everything should look like. But that may be just a matter of preference. Everyone has their own preferences. I haven't really found one of the biggest tests that I did recently that failed was giving Claude the ability to roll forward a financial model with new accounts. When the same accounts came in, it was able to actually do that, but the new accounts is where that actually caused an issue. So I think the management of a file, specifically when it comes to a roll forward, is still a very big piece that these models haven't caught up with yet. But the rate of improvement is so quick, I wouldn't be surprised if in no time we actually get to that point. To me, it's not about how do we ensure that we don't get replaced by Claude or these other AI tools. To me, it's how can we join forces? The areas that I know these tools can do really well, how can I leverage these tools in order to speed up a lot of what I would do? While the actual analysis, maybe I'm leveraging Claude, but I have more context specific about the actual business. What I keep hearing from everyone is we are moving from doing the work to reviewing the work. So it sounds like you already have that really strong foundation in place, which puts you in a great place to be able to leverage these tools, and you're kind of the orchestrator of things. But in addition to reviewing and knowing what good actually looks like, there's so much more also to a role than just the actual Excel file that you're working with. There's the relationship management. There's collecting the right inputs from the different department heads. They're presenting this information. So many other details that go hand in hand with creating a financial model, which AI can actually help with. So this to me means that it's never been a better time to really invest in cultivating the right relationships and network, especially if you don't have that skill set in place yet. That's another area that I'll actually focus on. So I hope that helps answer the question. That's at least my take on it. Anyone who says they know the answer to all of this, they're lying, because this is all completely new, and we're all just trying to make sense of this new time that we're in. All right. Well, I think that wraps up things. I don't know if there are any other questions. I'll answer one quick one. This is going to be the last one. Do I provide services in French? Personally, je ne parle pas français. I'm sorry. So I wouldn't be able to help you. But this has been an incredible session. I really enjoyed talking about my favorite topic, and that is financial modeling, ensuring that the accuracy is in place. I appreciate everyone who joined here. Once again, if we haven't connected, I would love to hear from you, whether that's a LinkedIn connection, a YouTube comment, or an email. So thanks everyone for joining. Thanks once again to ApprovalMax for keeping today's webinar entirely free and contributing to the amazing discussion. I look forward to seeing everyone at the next webinar. Take care, everybody.